presentation I'll be presenting is the ABC of responsible investing. So this is just a slide showing AJ Bell. For those who are not familiar with AJ Bell, if not a client yet, then just to provide some information, we're an award-winning DIY investment platform with access to several accounts, SIPs, ISAs, etc. We also do have some good investment research tools for you to use. Those incorporate AJ Bell funds, ready-made portfolios, and the favourite funds list. They are tools, not advice, but hopefully they do help our clients. So, to regard to the presentation, what is ESG? So ESG is a three-letter acronym, and it stands for environmental, social, and governance. And really, if any one or multiple of those words mean something to you, and you have a preference to focus in those areas, then you're absolutely in the right webinar tonight, and yeah, you've got good company here tonight. Now, what do we really mean by that acronym, and what does that really mean for the context of investing? Well, really, it's all about us as investors wanting to channel our capital, our money, into these three areas. So some kind of positive aspect of helping. So really being part of the solution and not compounding the problem. So when we say environment, I just want to give a bit more context around these three words. So environment includes factors that impact the natural world. And this ranges from lots of issues, but I think probably the most important ones are things like climate change, resource depletion, waste management, water management, pollution, deforestation, and then social. Social is factors impacting the lives of humans, and the issues here range from human rights, modern slavery, child labour, working conditions, employee relations, etc. And then governance. And governance, I find a bit of a funny one, because I kind of feel like any fund manager or anyone who invests in something would always use good governance practices in their investment process as such. But I think actually in the context of ESG, that's probably widened out and it's developed more recently. So here, we're talking about factors that impact business models or common practices, but actually this ranges from issues such as bribery, corruption, executive pay, gender diversity, to the board structure, political lobbying, donations, tax strategies, etc. So, hopefully that's kind of given you a good feeling for what we mean by ESG. Now, the next graphic on this slide shows the spectrum of ESG. It's quite a busy slide, so I'll kind of talk through it as easy as possible. So if we start from the left column, that's financial only. Now, it's not in green because it's not really ESG. These are funds that within their processes just use traditional finance. It's just traditional fundamental analysis. So looking at the balance sheet, earnings, revenues, but there's no ESG considerations as such. Then we start graduating towards using ESG credentials in investment processes. And the slide is probably missing just the ethical column, which I think really is the next one. So that's all about exclusionary policies, so excluding a whole host of sectors or industries or companies that are seen as harmful to people and the planet. And then we continue to graduate up through responsible, sustainable towards impact. And really the ESG credentials from left to right are getting stronger and stronger. And when we talk about impact, what we're really talking about is being able to create a positive societal benefit through the companies we invest through. And I think where impact really stands out is usually it's about the actual measurement and being able to demonstrate that impact as well. And I've got a slide on one that highlights impact reporting. I think that's really important in this context. And then the last column, really, again, it's not greened, it's kind of greyed out as such. And again, it's not really for investment as such, but it's impact only. So where you're not really considering any financial return, but more about kind of giving back. So you could even consider things like charitable work. So here, really, we're just concerning on ourselves on the columns that have the green heading, so responsible, sustainable to impact. Now, it's not saying any one is better than the other, but it's just trying to define exactly how ESG, the thought process that is running through those different types of strategies. Now, if that sounds confusing, unfortunately, it's because it is. And there is a lot of different acronyms, a lot of different names. There's a whole host of names that are completely missing from here, like best in class or SRI. And it's because there is a lot of different types of processes out there. They're all very similar, but they do have their nuances. So it is really important that we do understand the minutiae detail that goes into it. But for the time being, AJ Bell really wants to focus on this whole area being called responsible investing. That's kind of our umbrella term, just to capture all the different types of ESG flavors underneath. Here we can just see the incredible growth in the area, really. This is a study that's prepared every 2 years, so unfortunately we don't have the 2020 results yet. But you can just see the trajectory that ethical investing is going on. So this is a measurement of the flows, the amount of capital that's going into this area of finance through funds, and you can just see its rapid growth in most regions. And actually, if we have the results for 2020, I think what we'd see is a big growth in demand, and that's been taken up. In fact, we do have some investment association data I was looking at earlier, and you can see for the last 12 months there's been a continued pickup in flows into this area. Now, there was a small blip around March and April, but I think that was just very similar to what we saw in the whole industry, really. Money coming out as there was a slight COVID panic, but actually when you go past that period in April, June, July, it all picks up and the momentum is very strong. In terms of fund launches, there's been a whole host of fund launches this year alone, really focusing on this area. So at least over 100 different funds have come to market, and some have grown very, very big indeed already. One of the largest is already up to £750 million, and that's starting to become a more mature fund at that size. So incredible scope for flows to have picked up into those funds. So lots of demand out there. So we talked about what ESG is, and we talked about the demand. So really I wanted to kind of phrase it all around why now. Well, I mean, ESG investing, certainly no new phenomenon at all, although it might feel like that. The actual earliest ESG mandates really you can trace them back to the 19th century. It was all around really religious movements like the Quakers and the way they wanted to invest in charities as well. So it's not new, but it's definitely widened out and broadened out more recently. And I think there's very good reason why this is. And I kind of paraphrase it or put it into context by, I feel it's a meeting of minds and events that's led us to this place. So I think there's many groups of different types of people that are all coming together really to the same outcome, and that something needs to be done. So, I characterize them as politicians, scientists, and activists, and I think they're all possibly for once singing from the same hymn sheet. So, the politicians, there's lots of regulation coming with things like the EU taxonomy, but there's also been lots of regulation already put into place. So if I think of what the United Nations have done with the Paris Climate Agreement, which was signed in 2016, this is all around climate change and nations, and many nations trying to tackle this all together in a collaborative manner. So the idea here is that we could try and limit temperature rises this century to 2 degrees Celsius, but from pre-industrial levels. So that really means before the age of fossil fuels had any impact on temperature rises. Now, at the moment we're on target for about 5%, so there needs to be a lot of work done in this area. But people are very willing to do that. So again, that's why all this regulation is coming through, and why there's such an interest in this, and why companies are starting to behave differently. And then there's the 17 interlinking sustainable development goals as well by the United Nations, where their target is 2030 to try and eradicate things like poverty and give free education and access of education to everyone around the world. So really important things to do that actually companies and fund managements are also trying to develop and really link into. And then the scientists, I think this is really interesting chart. It's all about the Earth Overshoot Day. So all about when we start to eat into resources that are beyond the capability of the Earth to regenerate itself. So these days, we eat up about 1.6 times of the Earth's capability and resources regeneration each year. So you can just see from those bars in red how stark it is and how earlier and earlier in the year we eat into what the world can generate for us each year. Now you'll see the eagle-eyed among you in the audience will see that this year the bar has gone back up. I mean, that purely was due to the unfortunate circumstances of lockdowns and COVID, and the fact that globally people were stopped driving around. They actually think it's probably about a 15% saving in carbon emissions just due to that period, hence why that's gone back. But I mean, you can see there is a flattening out, I guess, but hopefully more and more work can be done where we can bring that back up to the end of the year again. And then activists like Greta, you know, I think, you know, these days they're not in the minority. What they're saying actually about climate change is much more about how, you know, we all think, particularly the younger generation as well. So I think these three groups are really putting their thoughts into practice and really making a difference as well. So I guess, you know, why invest and what to expect. So ironically, the fiduciary duty of many is actually holding back responsible investing. As there was this thought process many years ago about actually how if you invested responsibly, you're actually compromising some of your financial return. So people in the institutional world felt that the fiduciary duty was not to push ahead with responsible investing or to push this on people, because actually you'd be eating into your financial return. Now that's completely U-turned today, where people do feel that they can get a return from this mindset. So that fiduciary duty has completely U-turned into the point that actually people feel that it's their fiduciary duty to put this forward, put the case forward for responsible investing. And actually, if you were to visit an independent financial advisor from next year, there's new regulation coming into place to actually state that during that meeting, they would have to ask you your feelings on responsible investing and really present the case to you. Whereas at the moment, they could just ignore it if they feel that it wasn't necessarily necessary for you. So, you know, can responsible investing deliver positive outcomes? Well, there's lots of academic studies to suggest it does. I think it's very difficult to separate factors and actually really come with a conclusive argument. It definitely does. If you think of the value investment style factor, well, people have been arguing for really years or decades as to whether it actually adds anything. So we don't really know. The argument's out. I think it's very difficult to prove. What I can say is, for me, it's more important is there something else. I think clearly if companies are going to be much more proactive in this space, thinking about climate change, thinking about the future regulation, then they're clearly not going to get fined. It's not going to be a cost to their business if they're ESG friendly. Whereas if you're not, I think you can. So actually, for me, if you invest responsibly, I think what you can do is lower the risk. And I think in that sense, you then do probably achieve better risk-adjusted returns. But as I said, actually proving that responsible investing has a positive contributing factor is very, very difficult. And I mean, some people will turn to what happened this year with COVID-19 and suggest, well, that shows it does. I mean, I guess I'd just say a small word of caution on that, in that clearly in an environment where the oil price struggled and big financial organizations struggle because of lower interest rates, and these are two areas that possibly responsible investing does shy away from, then clearly responsible investing is going to do very, very well. But again, is it the actual factor of responsible investing driving that performance? The jury's slightly out there. But I think, I mean, more importantly, it's what to expect. Whenever you go into any investment, you have to go in with your eyes open and understand exactly what you're investing in. So, you know, responsible investing, the portfolios, the funds usually have structural differences to their mainstream indices. So I've shown here in the table the iShares MSCI World ETF versus the iShares MSCI World SRI ETF. So the one on the left is a great proxy for global equities more broadly. The one on the right is the ETF, which focuses on ESG credentials. And what you can see already is that the top 5 stocks are very, very different. Now, the commonality is Microsoft, one stock, but the other 4 are completely different. And you can see in terms of technology stocks, much more heavier and representative, better in the world ETF as opposed to the SRI ETF. And also you can see just the number of stocks as well. You're probably taking a bit more of a concentration risk if you were to do it passively through this ETF, and your structure of your sectors will be different. Now, you know, absolutely not necessarily a bad thing, but just to be very aware that your relative performance will be driven by these components. So stewardship engagement, this is, I think, really comes into its own in responsible investing. Now, stewardship is, very much the preservation and enhancement of the value of assets which one has been trusted in. So we expect all our fund managers to be good stewards of capital, but engagement is key here. So engagement and voting is the key part of stewardship, where ESG can really benefit, because what you're doing in this is opening up a dialogue with company management, with boards, and trying to influence them to be better companies and have better ESG credentials to benefit the company and the shareholders, and align views as well. Now, different ways you can escalate that engagement is you can have shareholder resolutions or collective engagement, and collective engagement is really powerful. It's where you can come together as investors and make sure there's more weight and emphasis towards what you want the company to do. Now, that might seem like quite a harsh tactic, but actually it's also very beneficial for the company as well, because what they're then hearing is one very clear message from their investors as to what they want to see from the company, what influence should be taken hold of. Whereas if you just have lots of smaller investors giving you conflicting messages, actually you may not get a clear message of what you need to do as company management. And then disinvestment, this is really the final, gets a nail in the coffin in some ways, is that you can just purely take your money away from a company if they don't think you're listening. Now, the downside here is that it means you don't have a voice and you can't influence change, but it is clearly a very powerful message to disinvest. So, I think we really need to talk around the ESG challenges now, and there are many. The first one, and I think the most important one, is it's so hard to define ESG. I think that's probably come across already in my presentation in some ways. It's incredibly difficult to define what responsible investing is and what ESG is. I think if you think of it as, imagine you were speaking to 3 of your closest friends in the pub, and you turn to all of them and ask them what they think their views on is best for the planet and people, etc. And I think they probably all come up with very sensible answers, but they'd be incredibly different. And I think that's important when you think of investing, is that you want to align your views to what you invest in. So, be a little careful in what you choose. Just make sure it is really what you choose. So there's lots of thematic propositions out there that might, specifically focus on climate change and the environment, or gender diversity, etc. And just make sure that what you are investing in is what you purposely set out to do, or just general ESG friendliness, which may also be something you want, just you're not exactly sure what you want directed your capital towards, but you want it to be better for the future generations. Now, the next problem really is consensus. Actually, we're struggling to define it, and then actually even agreeing what is ESG friendly is very difficult. And there's two in this box here, there's two main ESG rating companies, one Sustainalytics and MSCI, and you can see here this is the correlation, so a 0.53 correlation between MSCI and Sustainalytics in terms of their ratings, in terms of what they suggest are ESG friendly company. And you can tell, whilst there is some correlation, there's not a huge degree of correlation, meaning that they don't even necessarily agree themselves. But I think this is because it's such a wide conversation piece that some of their questions will be very different, their processes are very different. So I think there's probably merit to the rating systems, but they do focus on different things, which means you can have different outcomes. So I guess possibly we need to be careful to be over reliant on that. Now, companies under transition, I think this is an important point as well. There is no perfect company. Every company will have some kind of carbon emissions to it. But also, actually, what's powerful about ESG is what we're wanting to do really is change the poor companies to be better companies in some regards. So, then there becomes the question of how patient and how long do we wait for companies to transition? And then this ties in with the next point, actually, is greenwashing. What if companies are telling us just what they want to hear and have absolutely no motivation to becoming better companies? Then, that is really misleading, and actually it could be greenwashing. So we have to be careful to make sure that actually companies are doing better in the future, and not just pretending or telling us what they want to hear. And then the pricing of this area of investments, it seems to be coming as a bit of a premium. Now, I'm a bit of an advocate for saying it shouldn't really. There's been a lot of costing pressures in the industry of late, and I guess over the last 5 years we've really come some ground on this, and it's definitely a lot cheaper to buy funds these days, and I think rightly so. But ESG investing seems to have come at a bit of a premium. I think we're already starting to move that in a bit. Now, there's an argument that it can cost investment companies more. Clearly, they need to either pay for more data, or they need to resource their teams differently, or buy in a specialist team. So that pricing pressure, I think, will come in, which will be great. But personally, I don't believe there should be too much of a difference between this area of investing and traditional finance. Then, passive v active, maybe a quick word on the differences. We definitely see there's more flow into active historically, but actually passive is gaining more and more ground. I saw some statistic the other day suggesting that passive is growing at about 3 times the amount of active. You can see year to date, we're now looking at it's about equal. So, possibly passive will overtake active. Now, pros and cons into both passively or active strategies. Again, it's just understanding what you want and how instruments invest. But broadly so, passive follows a defined set of rules, while active managers can be a bit more freedom, a bit more concentration in what they invest in. Passive tends to rely on ESG rating providers as well, while active managers can actually internalize their processes. I guess they can focus their processes on what's important for them as a business. A different approach to engagement, I guess, as well. Passive is probably a bit more broad-based, where again, active can actually concentrate on their top positions in their fund, probably creating a bit more of an emphasis in their own fund. But again, passive is cheaper, as we know in traditional finance as well. I don't think we'll get away from that point anytime soon. How do active managers incorporate ESG criteria? I don't want to steal the thunder of the next presenters, but just very briefly, there's a variety of different ways active managers can implement ESG credentials into their offerings. The first one being exclusionary, literally just have a subset of the investment universe. Usually it works out to be about a third, where they could take out tobacco stocks, take out fossil fuels that are harmful to the environment. It turns out to be about a third broad-based. Second one would be outsourcing the ESG decision making to a rating provider, so they could go to MSCI, Sustainalytics, they could do their good fundamental analysis they do on their fund, and then overlap that with what the rating providers say and make their funds more green that way. Now, the third way, and possibly my favourite, although of course all would have pros and cons, is the internalisation, is where the key analysts look at ESG metrics and data as well as the true fundamental analysis they've always been used to doing. They incorporate that, and that gets put into the thought process from the very beginning. It's really embedded throughout the whole process, throughout the whole end-to-end process of the fund management piece, including the portfolio construction. And the last one is kind of a mix between 2 and 3. They can outsource it to an internal firm, internal team within their firm, to pass or fail their companies. Now, impact reporting is a developing area in this. There's lots of funds that bring out impact reports. Really what this is trying to do is it's trying to measure, it's trying to show the impact of their companies. So lots of them will do something like they'll show you the carbon emissions of their fund versus the index, and clearly what you want to see is it coming in well under the index to demonstrate the meaningful impact of investing in their fund. Now, these reports are quite heavy lifting. I guess they turn out to be about 20 to 30 pages, but I think they're well worth a look, and I think they'll become much more into the retail framework as well. So I think that's a really, really strong development in the area. Now, how we're responding as a company, clearly there's a lot of demand here, so we want to meet that demand. We think it's important as well. We think it's an area of finance which will become even more important going forwards. If anything, it may just become traditional finance. It may be that it integrates so well in the next 5 to 10 years that actually everyone really uses ESG, and I think probably rightly so. But so far what we've done is, if you're a follower of favourite funds, you'll notice we've beefed up the offerings for ESG funds, responsible investing funds in this area, and we've added on 4 new funds recently. So 1 from BMO, 2 from Lion Trust, and 1 from Royal London. So really just another disclaimer for you to read in your leisure, but that really concludes my presentation.